Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
If you're looking at a chart right now, it probably feels parabolic, but I want to reframe that. In early 2026, gold trading in that $4,600 to $4,800 per ounce band, even after a sharp pullback, isn't just some speculative blow-off. It's the logical output of years of policy choices, geopolitical stress, and a slow erosion of trust in the usual signposts, fiat currencies, sovereign bonds, and central bank guidance. Gold has always been the weird asset in the room. It doesn't cash flow, it doesn't innovate, it doesn't report earnings, it just sits there. But in a world where people are increasingly questioning the value of paper promises, that just sits there quality becomes a feature, not a bug. It's the thing that doesn't depend on anyone else doing their job right. Alan Greenspan, who I don't quote lightly, once said, "Gold still represents the ultimate form of payment in the world. Fiat money in extremis is accepted by nobody. Gold is always accepted." That line has been running under the global financial system like a bit of hard-coded source code for decades. And what you're seeing in the price today is basically the world's way of rereading that line and saying, yeah, that still checks out. Layer on the geopolitical backdrop, ongoing conflict in Eastern Europe, a volatile Middle East, and rising tension between major powers. None of that screams, relax, the system's fine. Meanwhile, inflation has come down from the post-COVID spikes, but it hasn't gone back to the pre-2020 comfort zone. Real interest rates are not convincingly high and stable. They're wobbling around in a range where holding non-yielding assets like gold doesn't feel nearly as expensive as it used to. So when you put it together, frayed trust in policy, geopolitical risk that feels persistent rather than transitory, and real rates that don't properly compensate you for the risk in the system, it's not shocking that capital migrates toward what looks like a safe harbor. Gold is functioning less like a speculative trade and more like a referendum on confidence. That's the frame I want you to carry through the rest of this episode. Let's talk about who's actually behind a lot of this move, because it's not just retail investors stacking coins in their basements. Central banks have quietly become the titans of this market. According to World Gold Council estimates, global official sector purchases stayed near record levels in 2025. We're talking well over 800 tons of gold added to reserves in a single year, and that's on top of a multi-year buying streak. That pace didn't just stop on New Year's Eve either. Momentum carried into late 2025 and early 2026. The key point here is this isn't opportunistic buy-the-dip behavior. It's strategic. Countries like China, India, Turkey, and several in Central Europe and the Middle East are deliberately diversifying away from an overdependence on the US dollar. They're doing it because they've watched how sanctions work. They're looking at fiscal trajectories and major reserve currency issuers, and they're asking, how much of our national balance sheet do we really want tied to somebody else's policy choices? When a central bank swaps a chunk of its reserves from treasuries into gold, it's not just changing an asset allocation line item. It's making a statement about sovereignty and risk. Gold can't be sanctioned in the same way. It doesn't depend on the credit of a single government, and it doesn't care who wins the next election. That's enormously attractive if you're sitting in a finance ministry watching the geopolitical temperature rise. And every ton that gets moved from the open market into an official vault is effectively removed from the tradable float. The above-ground stock of gold is huge in value terms, well over $15 trillion at these prices. But the part that actually trades, the visible float, is much smaller. When central banks soak up hundreds of tons a year, they're tightening that float and increasing the price sensitivity of what's left. So, if you're trying to understand why gold can sit in the high 4,000s and not instantly collapse under its own weight, central bank behavior is a big part of your answer. This is slow-moving, policy-driven demand that's less about trading P&L and more about reshaping the architecture of reserve management in a fragmenting world. Now, when prices move as dramatically as they have, the conversation always drifts toward, is this a squeeze? Is this some kind of engineered corner in the market? And to answer that, you have to look under the hood at how the gold market actually trades. On the future side, COMEX is where a lot of the visible action happens. Speculative positioning by money managers has been elevated. Net longs in that rough 200 to 250,000 contract range through January 2026. That's down from earlier peaks, but still well above what used to be normal before 2024. What that tells you is that trend followers and systematic strategies are very engaged. These are players who buy strength and sell weakness. They're not sitting around with a deep macro thesis. They're reacting to price, risk models, and signals. That behavior tends to amplify whatever the fundamentals are already doing. If gold starts trending up on the back of central bank buying and macro stress, systematic money piles in, pushes it further, and you get this feedback loop. At the same time, we've seen a huge expansion in liquidity. In 2025, total gold market liquidity was estimated around $361 billion per day, roughly half of that in OTC markets, a big chunk on exchanges, and ETF trading more than doubling to several billion a day. In tonnage terms, that's more than 3,200 tons changing hands daily across venues. Why does that matter? Because when you have that kind of scale and diversity of counterparties, the classic let's corner the market story becomes incredibly hard to pull off. You're not dealing with a thinly traded microcap stock. You're dealing with one of the most liquid, globally integrated markets on the planet, with miners, refiners, bullion banks, central banks, ETFs, and hedge funds all participating. Can you get localized squeezes or short-term fireworks? Absolutely. We saw that around the late January 2026 price break, followed by higher margin requirements on gold futures. When margin goes up, leveraged players are forced to shrink positions, which can create outsized moves relative to any single fundamental data point. But those are more like sudden gusts of wind. The longer-term direction is still set by macro gravity, real rates, currency trends, and that central bank demand we just walked through. So if you're an investor, the takeaway is don't build your thesis around some grand, permanent squeeze in gold. Understand the plumbing, respect the liquidity, and recognize that speculative flows can exaggerate moves without being the primary engine. All right, let's switch gears to silver, because silver is where the story gets both more interesting and more volatile. If gold is the steady monarch, silver is the restless sibling, part monetary metal, part industrial workhorse, part speculative flame magnet. The total market capitalization of above ground silver is a fraction of gold's, down in the low trillion-dollar range at earlier price points. That smaller base is one reason silver has a reputation as poor man's gold, and also why its moves are sharper. A given dollar of flow can push silver around a lot more than it can push gold. In the last several years, we've watched silver push higher, consolidate, and then break out again. By early 2026, it's been trading in a wide, volatile band, with recent quotes in the $80 to $82 per ounce area after some profit taking off record or near record levels in certain regional markets. In the scenario we're using here, silver in the low to mid 80s, those are elevated prices compared with most of the last decade. But just like gold, that move has a fundamental backbone. Over half of annual silver demand now comes from industrial uses. Think photovoltaics, power electronics, 5G infrastructure, auto applications, and a ton of consumer electronics. In the energy transition alone, silver is central. Solar panel manufacturers rely on its exceptional conductivity, and forecasts have solar related demand in that 120 to 125 million ounce range annually in the mid 2020s. So when you buy silver, you're not just buying a shiny store of value. You're buying a quiet piece of the green economy, embedded in solar panels, electric vehicles, the grid, and the circuitry that keeps your digital life humming. That industrial role interacts with its monetary identity in complicated ways. In times of stress, investors still reach for silver as a more accessible inflation hedge, especially when gold feels expensive in nominal terms. And here's where it gets even more interesting. Roughly 70 to 80% of newly mined silver comes as a byproduct of base metal mining, copper, lead, zinc, rather than from primary silver mines. That means supply responds more to the economics of those base metals than to silver's own price. You can get big demand shocks from solar, electronics, or investor flows, but the supply side can't just flip a switch and ramp. That structural inelasticity is a big part of why silver behaves like a wild card. They can look like a safe haven one year, a high beta growth proxy the next, and then suddenly go quiet if industrial demand softens. For investors, that volatility is both opportunity and risk. Whenever silver gets moving, the word squeeze isn't far behind. We've seen this movie a few times. The Hunt brothers in the late 1970s tried to corner the market and drove prices toward $50 an ounce before the whole thing collapsed under rule changes and liquidity constraints. More recently, in 2021, you had the hashtag Silver Squeeze episode inspired by the GameStop saga, which briefly lifted silver toward $30 before fading. What both episodes highlight is the same lesson. Precious metals markets are deep, globally distributed, and full of professional counterparties. Trying to brute force a permanent squeeze by coordinated buying almost always runs into that reality. That said, there are real tightness signals you should pay attention to. On COMEX, there have been periods where open interest in a single silver contract month sat around 528 million ounces, while registered stocks, the metal actually available for delivery, were closer to 113 million. That's a paper to registered ratio north of 4 to 1. In just the first week of one recent January, warehouses reportedly saw withdrawals north of 33 million ounces, roughly a quarter of registered inventory. At the same time, inventories at the Shanghai Futures Exchange have been trending lower into the mid hundreds of metric tons. That combination, elevated paper exposure, declining visible inventories in key venues, tells you the exchange-tracked portion of supply is tight. ETF flows add another piece to the puzzle. Research suggests silver ETFs saw meaningful net inflows in 2025, complementing strong physical and industrial demand and contributing to a market deficit expected to persist into 2026. You've also seen some of the more explicitly physical, closed-end vehicles expand their capacity. One major fund doubling its at-the-market equity program to around $2 billion, which, at these prices, implies the ability to buy tens of millions of ounces of physical silver. That's material relative to exchange inventories and underscores a shift among sophisticated investors toward allocated, not just synthetic, exposure. The divergence between outflows from some large, unallocated ETFs and inflows into more physical structures is the market's way of saying, we care about the difference between paper claims and metal that can't be rehypothecated. But, and this is important, None of that guarantees a permanent runaway squeeze. Miners, recyclers, bullion banks, and end users all adapt when prices get extreme. You can absolutely see sharp spikes when delivery pressure, positioning, and macro catalysts all line up. But the idea that a Reddit thread can permanently overpower a market this large is, in my view, fantasy. As an investor, you want to respect the tightness without basing your entire thesis on a squeeze narrative. Let's pull this together into an investor's framework. One of the classic tools people use is the gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold. Historically, in the modern era, that's floated in the 60 to 80 to 1 range. When it blew out way above 80, the usual story was silver is cheap relative to gold and may have catch-up potential. What's different in this cycle is that the ratio has compressed into roughly the high 40s to mid 50s in early 2026. That may not just be a blip. It could be a sign of a new structural equilibrium driven by two forces: relentless central bank accumulation of gold on one side and silver's industrial and investment-led outperformance on the other. Under the surface, the market's sheet music is getting more technical and data-rich. In gold, we talked about elevated but highly responsive speculative positioning, with net longs fluctuating as the trend ebbs and flows. In silver, you've got those big paper versus physical gaps, ETF flows tilting toward more physical exposure, and visible inventory drawdowns on major exchanges. Add to that the fractured global pricing picture. We like to talk as if there's one true gold price or one true silver price, usually a London or New York benchmark. In reality, the world is a patchwork of regional prices, premiums, and discounts. The Shanghai Gold Exchange has periodically traded at notable premiums to London, signaling strong domestic demand and tight local supply. India often trades at a premium too, thanks to import duties, taxes, and policy restrictions that limit inflows. Those east-west differentials aren't just trivia, they're stress indicators. Persistent premiums tell you where physical metal is most desired and where the plumbing is constrained. COMEX is primarily a futures venue. London is largely unallocated OTC, and places like Shanghai put more emphasis on physical settlement. Central bank purchases, which are typically physical and discrete, add another layer by quietly shrinking the pool of freely available bullion. So how do you invest in this kind of environment? My framework is pretty simple. Gold is your anchor. It's the asset you hold against real rate suppression, currency debasement, and systemic risk. You're not buying it to triple, you're buying it to still be standing when a lot of other things aren't. Silver is your higher beta companion. It gives you leveraged exposure to many of the same macro forces, plus the secular tailwinds of the energy transition and digital infrastructure. In a diversified portfolio, that usually argues for a larger, steadier allocation to gold and a smaller, more tactical allocation to silver. You size silver so that you can live with its drawdowns without panicking. You think in cycles and years, not news cycles and weeks. And you resist the urge to build your whole thesis around the next short squeeze hashtag. All right, I'll leave it there. In this cycle, gold and silver aren't relics. They're barometers, and for some investors, shock absorbers. If you're thoughtful about sizing, time horizon, and the difference between paper and physical exposure, they can still play a very real role in a modern portfolio. I'm Josh Barone. Thanks for listening to Intelligent Investor Insights. Take care of yourselves, stay disciplined, and we'll talk again soon.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation. and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence. Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.